Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving to a proxy statement from Cumulus Media. It might sound dull, but stick around because inside these filings are clues to what's really going on with a company. It's like a treasure hunt, but instead of gold, we're looking for financial insights. Think executive pay, board changes, and everything in between. This one promises some drama involving management and shareholders, maybe some high-stakes disagreements about money and control. First things first, what's a proxy statement? Think of it as a voting guide for shareholders. It tells you what's up for a vote at the annual meeting, like who should be on the board of directors and if the big bosses are getting paid too much. It's basically the company's way of convincing you to vote their way. One thing that caught our eye is how Cumulus is trying to turn things around after some tough times. Apparently there were accelerated national headwinds, whatever that means. Seems like a nice way to say that their company had trouble because of the economy. They're talking a lot about improving employee engagement and listening to shareholders. It looks like some of the top people were not very popular, so the company did heavy damage control, trying to listen to shareholder concerns. After their last annual meeting, they went on a listening tour. Meeting with lots of shareholders, they claim that they reached out to shareholders representing 96% of their identifiable shares and spoke with 78% of them. That's a lot of meetings. They promised that any feedback that was received would get implemented in policy changes, and it seems like they made some actual changes. They now have a policy where directors who don't get enough votes might have to resign. That's a pretty big deal. Directors don't usually like to give up their seats. They also decided not to renew their poison pill. What's a poison pill, you might ask? It's a measure that makes it harder for someone to take over the company. It looks like shareholders were not in favor. They recruited a big shareholder, Stephen Galbraith, to be on the board and run the compensation committee, the team in charge of paying management. That sounds like a direct response to shareholder gripes. And get this, management even recommended cutting their own pay. They're decreasing pay for top managers by 16% to 18%. Now, is that for real or just for show? We will see. They also changed how they measure success for bonuses, focusing on things like profit margins and shareholder returns over the long term. Hopefully these changes are more than just lip service. Now let's take a quick look at who's running the show. We have 7 director nominees. Each of their qualifications and experience is conveniently outlined. There is also a handy chart. They checked various boxes like financial skills, media experience, and digital expertise. Most of them have senior management experience. Mary Berner has been CEO for almost a decade, so it's safe to say she knows the company inside and out. Thomas Castro has experience in private equity and radio broadcasting. Deborah Farrington brings venture capital and corporate management experience to the table. Stephen Galbraith, the new guy, has a strong background in investment management. Joan Gilman has executive experience in media and telecom. Andrew Hobson knows his way around finance, especially in the media industry. Brian Kushner has a background in corporate restructuring and financial management. Alright, let's get into corporate governance. It's like the rule book for how the company is run. They have 6 independent directors out of 7. That's good. An independent chairman of the board is also a plus, as well as the regular executive sessions of independent directors. So the company encourages all directors to attend annual meetings, which is very standard. Also, they allow shareholders to call special meetings if they have at least 25% of the voting power. As said earlier, they have a director resignation policy in place if someone doesn't get enough votes. Now, who owns the company? This section tells us who the big shareholders are. All the directors and top executives together own only about 12% of the company's Class A stock. Not a lot of skin in the game, so to say. Renew Group Private owns 6.2% of the Class A stock. They are really playing up their stockholder engagement. As said earlier, they reached out to most of their identifiable investors to get feedback. Now, for the juicy stuff, executive compensation. This is where we see how much the top dogs are getting paid. It also highlights the changes made in the wake of stockholder feedback. In 2024, the top 3 executives were Mary Berner, the CEO, Francisco Lopez Balboa, the CFO, and Colin Jones, who's in charge of corporate strategy and Westwood One. The goal of their pay plan is to link executive pay with company performance and shareholder value. A big chunk of their compensation is at risk, meaning they only get it if the company does well. For Berner, 72% of her potential compensation was at risk. Some good practices that they have in place is that they link compensation to performance and have clawback rules to take back pay if something goes wrong. They have stock ownership guidelines and prohibit hedging and pledging their stock, and they do not provide excise tax gross-ups upon a change in control. They even have an independent consultant who helps them figure out how much to pay their executives. And they compare the top people's pay to what similar people make at other companies using a list of peer firms like Comscore and Entravision. After last year's annual meeting where a lot of shareholders voted against the executive pay packages, Cumulus went into overdrive doing a lot of engagement. The shareholders wanted multi-year goals set at the start, and so the board obliged. This is a great win for the company's shareholders because they want to see a connection between executive compensation and shareholder value creation. Management even decided to reduce total direct compensation for the CEO and CFO by 18%, which sounds like a move in the right direction. Okay, now let's jump into the numbers. In 2024, Berner made $4.6 million. Lopez Balboa, the CFO, made $2.4 million, and Jones made $1.4 million. Berner's base salary was $125 million. Lopez Balboa's was $800,000 and Jones was $650,000. They also get bonuses based on performance. In 2024, they were measured against adjusted EBITDA. Actual payments were lower than initially anticipated. They also get long-term incentives like stock and cash awards. These are earned over multiple years based on metrics like adjusted EBITDA, controllable expenses, and digital marketing services revenue. Prior year awards got between 54% and 88% of their target. They claim to be doing a lot to manage risks, including cybersecurity. They claim that the CFO updates the audit committee every quarter. They have a code of ethics for all employees. Finally, the company was at risk of being delisted from the Nasdaq because its stock price was too low. Now they will be traded on the OTC markets, which is not exactly a vote of confidence. Alright, let's tackle the pay versus performance table. This is where we see if the CEO's pay matches how the company is doing. The table shows the CEO's total compensation compared to metrics like shareholder return and net income over the past 3 years. For 2024, the CEO's compensation was $4.6 million and only a 7% return in shareholder value, which explains why the actually paid part was only about $1 million. So, what's the bottom line? Cumulus Media is trying to win back shareholder trust after some missteps. They've made changes to their board, compensation practices, and corporate governance. It remains to be seen whether they'll have better say on pay results next time, but it looks like the management team is at least trying to respond to the shareholders. It is interesting to see how the numbers in the report do not tell the entire story, which makes it look better than it really is. They seem to be dancing in order to stay afloat. Thanks for watching Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more insights into the corporate world. Let me know in the comments if there is any other company that you want me to decode.